Live from Singapore, this is Insight with Haslinda Amin, where we dive deeper into the stories that matter with crucial context and sharp analysis. Oil surges after the U.S. announces sanctions on Russia's biggest producers as President Trump ramps up pressure on Vladimir Putin to end the war in Ukraine. Omar Slim from PineBridge Investments says markets are underpricing inflationary pressures and factoring in too many Fed rate cuts. He joins us just ahead. Jean-Claude Trichet, former ECB President and one of Europe's most influential economic policymakers, is with us live from Shanghai to share what he sees as the biggest risks to the global economy. And the CEO of India's JSW Steel is also on the show to explain how the lower rates environment will affect his business. We'll also get his views on what an India-US trade deal should look like. Plus, we hear exclusively from South Korea's finance minister about talks with the U.S. on Seoul's $350 billion investment pledge. Let's get to our top story. Asian equities are under pressure as traders weigh a fresh flare-up in geopolitical tensions. Tech stocks turning risk-off, with the U.S. set to consider export restrictions against China that would bar the purchase of critical software. Gold also pulling back for a third straight day on concerns its rally is overheated. On the other hand, oil prices are surging after the U.S. blacklisted Russia's biggest oil producers, Rosneft and Lukoil, due to what it describes as Moscow's lack of serious commitment to end the war in Ukraine. President Trump has also signaled that his planned second summit with President Putin could be in jeopardy, saying he doesn't want to have a wasted meeting. Let's dig deeper into the rally in oil prices with Stephen Stepczynski, who leads Bloomberg's Asia energy coverage. Stephen, talk us through what's happening in the market. Is this a reflection of how effective the market's predicting these new sanctions will be?
You know, I think the market isn't sure how these new sanctions will be in terms of the effectiveness. I think more this is a show that there's a different strategy coming out of the United States and G7 in general, right? So before, there was an idea that they needed to continue Russian oil hitting the market to help ease potentially supply shocks or high prices. There was the price cap. That was the famous structure that the G7 came up with so that countries like India would continue importing Russia oil would be below market prices, so it would curb the amount of money going into Moscow's coffers. Now this strategy is looking at actually potentially disrupting Russian oil flows. Rosneft and Lukoil make up about half of Russia's oil exports, and that's a big amount if these are effective. Now that's the big question. That's what you first asked, because will the Trump administration go after shadow fleet vessels? Because the flow of this oil is likely going to continue on blacklisted ships, on ships that have turned off their AIS signals, their satellite signals, to continue kind of exporting the fuel. And that's what has been happening for the last few years. So it really comes down to how closely the Trump administration will look at this and how closely they're going to enforce these new sanctions.
Well, the thing is, it's coming at a time when we're seeing an oversupply of oil, right? We're talking about 3 million barrels, and that could help, I suppose, overcome the concerns in the market.
You know, I think that's a good point, right? We are in a market that is frothier compared to 2022 when the war in Ukraine began and when they started coming up with the price cap mechanism. At the same time, you know, while the IEA and others are expecting an oversupply in the market in the later part of 2025 and in 2026, there does provide a little bit of cushion to take that supply out of the market. Also, I think you can't discount OPEC Plus. I mean, Russia's part of OPEC Plus. If suddenly those supplies are being curbed, there is a way potentially that Saudi Arabia or other OPEC members could speed up adding barrels to the market to provide more of a cushion, to provide more of an element to help push down prices if they so want to do that. But it is correct. We are in a different market now than we were a few years ago. So taking the chance or being stricter with sanctions and trying to really hit Russian crude head on would have a lesser impact. And that's why we're seeing Brent at around $65 right now compared to over $100 when the war began in 2022.
All right, Stephen, thank you so much for that. Stephen Stepczynski, who leads Bloomberg's Asia energy coverage. Now, oil's price swings are also a factor. As we look ahead to this week's delayed U.S. CPI data, forecasters expect both the headline and core inflation rates to have risen, primarily driven by the lingering impact of tariffs and service sector costs. Our next guest believes that inflationary pressures are underpriced. Let's get insights from Omar Slim, co-head of Asia Fixed Income at PineBridge Investments. So, underpriced, how do you factor that into the oil prices we're seeing today?
Yeah, I think for the oil prices, we're seeing an uptick in terms of prices. I don't think it will obviously play into the next CPI release. I think it will gradually play into inflationary pressures. But I think
not much, right? It's 64, not 100, as Stephen was talking about.
And I think, as your previous guest has mentioned, I think the main point here is that this signals a change in terms of strategy, in terms of actually disrupting the oil flows. As opposed to before, I think people or some of the countries, including the Biden administration, for instance, which actually thought about sanctioning these two entities, they were doing these half-hearted measures because they were concerned about the impact in terms of the market, which now seems to have subsided. I think in terms of the view, in terms of inflationary pressure, I think this is predominantly coming from two reasons. The first one, I think the market is starting to kind of think that tariffs are not a big deal. And I think this is a premature way of looking at things, because I think there has been a lot of distortions in terms of tariffs. We had some false starts. We had Liberation Day, then we kind of backtracked. Then there was a lot of front-loading of imports or exports, depending how you look at it. And then there was a lot of inventory stocking and so on and so forth. So the point is, we don't actually know for sure what the impact of the tariffs is in the U.S. And I think there has been so far some of the companies absorbing the tariffs, and I don't think that's sustainable. So I think it's too soon to say that tariffs are not a big deal, particularly in the U.S. The other reason is that there is this view that the labor market is weakening, which is frankly, even the Fed is saying that. I think this should be a very nuanced view, because I don't think the labor market is very broadly weakening. I think we're seeing pockets of weakness, particularly given some of the immigration patterns that have changed and so on and so forth. But it is a rather K-shaped economy and a K-shaped labor market. So I think the labor market is still relatively strong, I would say, with some pockets of weakness.
Yet, Omar, some are saying we should be bracing for a 50 basis point cut, not 25. I mean, what are they missing out on? I mean, what are they being misled by?
I think that's probably more aspirational. I don't know if we're missing anything, but I don't see the case for a 50 basis points cut. I think 50 basis points usually is when the Fed is trying really to catch up on things, and I don't see it happening now, particularly with inflation being where it is, and with the fact that the labor market is really it's not falling apart. I think we're seeing some weakness in the labor market. I think if we see further weakness in the labor market, which is much more broad-based, then the case for a catch-up cut of 50 basis points can increase, but I don't see it now.
How important is that CPI print tomorrow? People say yes, but the thing is, it's a delayed September CPI print. It could blur instead of provide clarity.
It can, but it also shows the direction of travel. And you need to remember, we also have been flying blind, frankly, for the past few days, few weeks, because of the government shutdown in terms of some economic indicators. So I think it is an important number to watch, particularly in terms of direction of travel for inflation. But you're right in saying that I don't think it's going to be a definitive kind of metric to kind of base. However, I do think it can move markets, particularly if it surprises on the upside.
How much upside? I mean, what number would would shake the markets?
The markets now are pricing in, 50 basis points of cuts this year, so 2 cuts. And then, more importantly, at least from my perspective, even more cuts for next year. So I think the market is kind of pricing in too many Fed cuts at this point, particularly given that I believe the inflation pressures are underpriced going into this fourth quarter and next quarter. So I do think that the Treasury market can react if we see a surprise, particularly if it's more than a surprise of more than 20, 30 basis points in terms of what's expected.
The other issue that's taken the market by surprise is actually the private credit, bubbling away, they say. Is there reason to be cautioned? Because we heard from the likes of the BOE governor saying that, perhaps it is time to look at the space. He is stress testing the private credit in the UK.
I think there is reason to be cautious for a few reasons. The first one is we're not really sure what's out there. It's a market that's reasonably opaque, and I think there's private credit and there's private credit. There's some that have been done with strict underwriting standards and others that are not. So I think it's difficult to kind of have a broad brush statement in terms of private. It's a big market, but that's also an issue that has become really a big market. Now, without going too much into the specifics of what's happened with the 2 regional banks in the U.S., because we simply don't know, but generally there has been said that this is part of a fraud, which, I think that's probably a factual way of describing it. But it's also one way to think about it is whenever there's a market which is witnessing kind of an exuberant behavior or investor behavior, whenever there's like irrational exuberance, underwriting standards tend to slip, which is conducive to have fraud. I'm not saying that's what's happened this time, but what I'm saying is that's a relevant question to ask. And I think the cautious tone from the BOE and JP Morgan CEO Jamie Dimon saying whenever there's one cockroach, there's usually more than one. I think that's a fair point as well. So
the market is opaque. It is illiquid. Right, that's one area of concern. The other area of concern is that when you take a look at U.S. banks' exposure, it is in excess of $300 billion. That's massive. If we begin to see an unwinding, that could happen rapidly.
It can. I think the bank's exposure is quite big, but I think there's also exposure elsewhere as well, particularly perhaps with the asset owners and some private banks and so on and so forth. So a sudden stop event can happen quickly. I think a lot of those strategies tend to have some gating mechanism and liquidity kind of management mechanism and so on. But you're right that there is a risk there. And the risk is difficult to quantify simply because it's not a market that's as well regulated as the banking segment. So when the BOE is actually stress testing, it'll be interesting to see how they're actually stress testing it, because they actually also need to know where it went. So I think it'll be interesting to see what the results are.
So if there is contagion, how might this contagion play out? Who will be worst hit?
It's a good question, and the short answer is we don't know. We think that some of the banks, I think, will be. We got a bit of a teaser of that in terms of what's happened over the past few weeks, but also before that with some of the kind of Japanese regional banks or some of the kind of smaller banks and so on. So I think the short answer to your question is we don't know. I think it's partly the banks, partly some of the asset owners, and partly more the kind of the retail market.
Okay, Treasury space. Very interesting. We're seeing yields dropping, and some say expect yields to drop further. We have, 10-year yields below 4, and they say, you know what, that's going to be the trend going forward.
Well, I think that is also premature to say. My view is that there are some that are saying that we're not going to see 4 again on the 10 years.
Do you agree?
I don't necessarily agree, no, because I do think that the inflationary pressure can move the market. I think the risk to my view is that the labor market weakens even further, but I just don't see it at this point. I think we're kind of in this situation where we're not seeing a lot of hirings and we're not seeing a lot of firings, and that kind of can continue for some time. So for the treasuries, I do think that there could be some pressure, particularly in terms of the long end. And I do think that the term premium for the treasuries, given what's happening in the U.S. in terms of the fiscal metrics, perhaps the institutional framework, which is kind of being challenged here and there, I do think that the term premium is also underpriced.
But the longer-term trend would be for yields to drop?
Well, generally, that's what the long-term trend has been. In this particular instance, I'm not so sure that that's the case, because I think there's a view that the Fed is now restrictive. Even the Fed has that view that it's being restrictive. And I don't think that's necessarily true. Because if it has been so restrictive, we should have been seeing the economy slow down much more quickly. And there has been a lot of things that have been thrown on the economy, frankly, over the past few years, not only the past 3 quarters with trade tariffs and so on. So I think that we seem to be in a place where the natural rate has increased. So I do think that the rally so far probably has legs, but I think that for another leg down in terms of rates, I'm not so sure that it's going to happen this year.
So what are you positioning for in the bond market? What have you been doing?
I think the curve, the term premium is not well priced. I do think that the curve should steepen more because of some of the fiscal metrics, the institutional framework, but also the supply. So I do think that the curve should be steeper. I think generally the credit markets, have not really taken note yet of some of the, let's call them the credit incidents so far. I think the view is that it's very idiosyncratic. I'm still with that view because we don't have anything to the contrary, but I do think that there is caution there. So I think one needs to be careful in terms of the credit space.
That brings us really nicely to the dollar. Where does it go from here? There's been a lot of talk about debasement, this pullback away from fiat. What's your take on that? And are there signs that it is actually happening?
So that's a great question, and it's a heavily debated question. To answer the second part of your question, has there been signs that it's happened? I think yes, but very selective. I think the gold rally is the biggest manifestation of that debasement trade, as well as what one can call broadly fiat substitutes.
But now we're seeing an unwinding of the gold trade.
Yeah, but I wouldn't read too much in terms of the unwinding. I think that's probably some profit taking. I mean, the gold is up, 60%, 55% year to date. It's really a big run. So I wouldn't read too much in terms of what happened today and over the past 2 days. So the debasement trade, I think, is there. But I don't think there is another currency that is benefiting from that. So I think the dollar is still dominant in terms of, let's call it the fiat currency. And I do think that can continue simply because there's no other market that can absorb that kind of liquidity and that size. But I think what's happening in some kind of alternative markets like crypto, as well as the dollar, is a sign of some debasement.
Omar, we just have breaking news headlines here right now. We have Russian oil supply to India set to fall to near zero, and that's according to sources. Of course, we know that India and the U.S. have been negotiating, and there's talk about how, those tariffs on India will fall to something like 15% from the current high level. This could possibly be one of the reasons why. What's your take on what we're seeing?
So that's actually quite interesting. So there has been some rumors that there is some progress in terms of the U.S.-India negotiation. And obviously, the focal point has been the supply of Russian oil into India. If that is true, it is a significant step, particularly given the historical connectivity between India and Russia. And it goes back to what I was saying earlier, that the oil prices are responding not so much specifically on the sanctions of these two entities, but there does seem to be a renewed effort to actually choke the oil supply from Russia, which before used to be more of kind of half-hearted measures, to be honest.
I just want to know what the impact would be on the Indian rupee, which has been hovering at really low levels. Before we wrap it up, I just want to ask about dollar-yen. I mean, that's one trade that everybody's looking at.
Yeah, I think there's a lot of excitement about that and about the Takaichi trade. I do think that the return of Abenomics is unlikely. I think there are certain things or certain segments that will benefit from kind of some return of some Abenomic trades. There are some expectations that the yen is going to rally substantially. I don't see it happening, and I think it's going to be driven by what happens to the dollar. I think the yen will continue to gravitate between kind of the 145, 155 range.
All right, Omar, great to have you with us. Omar Slim of PineBridge Investments. Now, still ahead this hour, we'll hear exclusively from South Korean Finance Minister Cheol on progress in talks with the U.S. over Seoul's $350 billion investment pledge. Meantime, we bring you live pictures of Brazilian President Luiz Inácio Lula da Silva. He is in Indonesia as part of his visit to the country, followed by Malaysia, where he'll attend the ASEAN Summit and East Asia Summit. By the way, he'll be the first Brazilian president to actually attend the ASEAN meeting. His itinerary includes bilateral meetings with host nations and other visiting leaders. There you have it, the two leaders in Jakarta shaking hands as we speak. Now, this is Bloomberg. Welcome back. You're watching Inside. South Korea's finance minister says trade talks with Washington are now focusing on the structure of Seoul's $350 billion investment pledge rather than a currency swap. We spoke exclusively to Cheol about the progress of negotiations.
지금 베센트 장관은 한국의 외환
Besant has understood that due to the current state of Korea's foreign exchange market, we cannot pay up front. He understands that. However, regarding how to proceed on this, with negotiations currently underway with the U.S., I ask for your understanding that I cannot yet provide specific details on the plan.
Bank of Korea Governor Lee Chang-yong said that the maximum amount that can be raised in dollars annually without market disruptions is $20 billion. Are we looking at around those figures right now?
예, 저희들이 maximum.
Yes, the Bank of Korea currently estimates that the maximum amount we can raise without significantly impacting the foreign exchange market is $20 billion.
What does that mean for upfront payments, though? Does that mean front-loading some and then paying annually?
그런 부분
Regarding that aspect, we are keeping various possibilities open for the foreign exchange market and are currently in negotiations with the United States.
Because that's one of the options that you've talked to Secretary Besant and to Washington about.
그것은 제가 지금 확인하기가 어렵고요. 다만
I cannot confirm that at this time. However, Secretary Besant fully understands the difficulties in Korea's FX market and is having internal discussions on how to respond to the situation.
Because of the potential financial shocks to South Korea, there was a lot of talk about a potential currency swap agreement. Is that still on the table?
통화 수합은 미국과 한국 간의 이
Whether a currency swap is needed and to what extent will depend entirely on how the deal is structured. It may not be necessary at all, or it could be arranged on a smaller scale. Therefore, the currency swap itself is a necessary condition, not a sufficient one. So, depending on how this deal turns out, we plan to consult with the U.S. regarding the currency swap aspect as well.
통화 수합이 된다고 인해서
Even if we have a currency swap, it will be difficult to just blindly provide money to the U.S. without considering the commercial rationality or viability of the project being selected.
I'm understanding then that this option is still alive. If that's the case, when it comes to perhaps the structure, could it be something similar as to the Argentina style going through the Treasury instead of directly from the Fed?
지금 이 통화 수합에 대해서는 우리가
Regarding the currency swap, we're not doing it because we lack short-term foreign reserves like Argentina. It's a situation where Korea needs foreign currency to make long-term investments as requested by the U.S. So the U.S. must provide the lacking foreign currency. Therefore, it doesn't align with the conventional short-term currency swap structure. So, regarding that aspect, if we were to engage in a currency swap arrangement with the U.S., there are further points that require discussions.
And that was South Korean Finance Minister Cheol speaking to us exclusively. Keep it here with us. This is Bloomberg.
I think the U.S. has always underestimated China's bargaining chips. We view in the United States as a relationship that's a one-way dependency, that China depends on us and we don't depend on China. I've written 2 books. I'm actually starting a 3rd on codependency, where we both depend equally on each other. And I think China is demonstrating the two-way nature of this important economic and security relationship.
First of all, I think wealth management becomes a very important initiative for DBS China and also for the group. I think there is a permanent shift of the wealth management industry in China. The high net worth individuals are more matured and they look for safe assets and diversification of asset allocation.
Some of our guests from the Bund Summit in Shanghai this morning. Now, the annual Bund Summit is getting underway in Shanghai, bringing together policymakers, academic leaders, and senior financial executives. Our Chief North Asia correspondent, Stephen Angle, is there. And Steve, what are the main themes you're watching from the summit and your conversations so far? We've had China front and center.
Yeah, I mean, this conference held every year here in Shanghai is coming at a critical time, no doubt, in the trajectory, if you will, of the U.S.-China relationship as well, because we've had 6 months now of tariffs and the impact it's had on the global economy and two-way trade, or not even just two-way trade, global trade. And then, of course, you have the potential and the specter of a meeting between Xi Jinping and Donald Trump coming up next week, potentially on the sidelines of APEC in South Korea. So there's so many factors that are diverging or are converging at the same time, at a time when the U.S. markets obviously are showing some signs of wobbliness, if for lack of a better word, and the specter of stagflation is rising as well in the United States. And China has its structural issues, no doubt. Persistent deflation. That is something that I just talked to extensively with Huang Yiping, who's a PBOC advisor and a Peking University senior professor. There's still lots of challenges in this Chinese economy. So what is going to be the policy response here if a expected stabilizing of the U.S.-China relationship doesn't necessarily happen when Xi and Trump meet? So let's turn some of these questions over to our next guest, who joins us live from Europe, and that is Jean-Claude Trichet. He is the former European Central Bank president, the ECB president. He served in that role for 8 years. He's the chairman of the International Advisory Council for this current Bund Summit. Mr. Trichet, good to see you again, as always. I just laid out some of the challenges that the global economy is facing, given some of the credit risks that are bubbling, given the challenges that China's facing against the backdrop of the geopolitical struggle across the Pacific. How would you assess the health of the global economy right now, sir?
Well, I would say that we have, in a way, avoided a real catastrophe. I remember the time of the Liberation Day and all the bad consequences that were ensuing all over the world. Then we had, fortunately, the pause, only 7 days after the start of this rocky period. So all taken into account, we went through this, I would say, dramatic change in the policy of the United States, new administration, not dramatically. That being said, the scars are still there. We can see in the case of the relationship between the US and China, how it hampers the, I would say, global economy, taking into account the size of these two economies. And we have also to consider that the world today, also independently on the changes of policies that I just mentioned, the world today is in some respect more dangerous than it was even before the Lehman Brothers crisis, because you have an overall amount of debt outstanding, public debt and private debt all over the world, which is higher today than it was at that time. So that creates, of course, elements of fragility, which calls for extreme, I would say, vigilance for all those who have a responsibility, and I'm speaking both of the public sector, the authorities, and the private sector. So let's be very vigilant, very cautious. The world is really dangerous.
Mr. Trichet, you talked about how the world is in a period of fragility, and that has to do a lot with the debt we're seeing right now. We're also beginning to see perhaps caution when it comes to private credit. We heard the likes of Andrew Bailey saying that he's stress testing that market. How are you assessing the risk from that?
I think it is part of the problem we have. As I said, debt outstanding has increased a lot, and we have also seen a lot of increase in areas that are not in the hands of the commercial banks, namely not in the hands of these, I would say, entities that are under regulations, entities that are under potentials. So clearly there, on top of the volume of the credit concern and the outstanding debt concern, we have also a problem of absence of appropriate, I would say, handling of the overall regulations in the non-bank sector. And what you are mentioning is part of this problem, which calls, and I fully agree with the Governor of Bank of England, extreme caution, extreme vigilance.
Sir, it really struck me in your first answer when you mentioned that this current issues that are rising, the dangerous situation you talked about in the credit markets, is potentially even worse than the Lehman collapse, and what subsequently happened was the global financial crisis. What is your urgent call for regulators, for central bank chiefs, for policymakers and corporates to do to fend off what those storm clouds suggest?
Well, I was mentioning one indicator, of course. I am not a Cassandra which announced a catastrophe in a few days or a few half days. We have to take into account a lot of indicators. And one very major indicator is that the authorities in particular are extremely vigilant. We could see that when we had these problems of the regional banks in the United States, the rapidity of the reaction of the authorities and not on the Treasury and the central bank was striking. So nothing to do with the period immediately after Lehman Brothers, when there was a lot of hesitation of what to do exactly, and a lot of absence of full understanding of the gravity of the situation. So from that standpoint, I mean, the vigilance of the authorities, I am reassured. But I mentioned one indicator, which is an objective indicator, namely the outstanding debt as a proportion of GDP at a global level, and also at the level of the advanced economy, as well as the major increase in the emerging world, and China is also a case in point. So we have really there elements that are calling for great vigilance.
To a certain point, tied to that is central bank independence. I know you're on record as saying you're quite concerned what has transpired in the United States. How important at this time then is that central bank independence from leaders and policymakers?
I think more than ever, of course, in such periods which are extremely dangerous, the central banks, which are always at the front line when there are big problems, have to be independent. I think it was really one of the major conclusions of the last 30 years, and certainly one of the major conclusions after a period which was a very, very important period after the first oil shock and the second oil shock. And realized at that time that independent central bank was really of the essence. So from that standpoint, of course, I am alarmed by the, I would say, observation that we have of the relationship between the executive branch and the central bank in the United States of America. I consider that it would be very bad if it appears that the independent Fed, which was, I would say, fiercely independent in the recent period, as well as since many years, it would be a catastrophe if it appears that the Fed becomes depending on the executive branch. The market will not appreciate that at all, and I am sure that the impact that that could have on the market would be a reason for the executive branch concerned to not to continue to embark on such a move. We will see.
Mr. Trichet, I'd like to pivot to cryptocurrencies. I remember back in 2019, you talked about how you doubt cryptocurrencies can be the future in finance, play a role, in fact. Given where Bitcoin is trading right now in excess of $100,000, I mean, how are you looking at the cryptocurrency space? Do you still hold the same view?
I would make the difference between the cryptocurrencies that have not the characteristics of currency, according to Aristotle, namely be a unit of account, a mean of exchange, and a store of value. The Bitcoin you mentioned is not a store of value. It goes up and down, up and down. I would say it's more of a speculative asset. And I don't think that this speculative asset could really be a currency. And that's the reason why the main issue now is what do you do with the overall stable coin? And I have to say that from that standpoint, we could see a very rapid expansion of the stable coin. Over 5 years, it went from 5 billion to 300 billion or something, and it will continue to grow. Of course, the administration in the US has a special attention to this new instrument, the stablecoin. We will see where we go, but my own understanding is that it has to be controlled. The major mistake we made, in my opinion, in the past was to let these so-called speculative instruments, like the Bitcoins and many other, gallop with the theory and the doctrine that they were totally independent of any authority, that they were not regulated by any kind of normal regulation, if I may, and that they could do whatever they wanted, including financing criminal activities, including financing terrorism, why not, including fraud, fiscal fraud, and so forth. So that was not correct. And I stick to my previous position. We should not let this galloping of, I would say, totally unregulated, totally obscure operations. But we have to care for the new instrument. Yeah.
Here at the Bund Summit, I want to bring it back quickly to the tariff issue. We're obviously waiting a Xi-Trump meeting, possibly to find common ground, or maybe not. The first 6 months has not created tremendous amount of inflation as predicted. What do you think the next 6 months potentially could see on the trade front if this tariff regime continues and even escalates?
Well, I think that the economists were not wrong. I mean, because it takes time for inflation to be pushed up by the tariffs. And in my opinion, it is delayed, but we have to expect, unfortunately, of course, an impact on the US economy, which would not be negligible. And of course, comes at a moment which is not opportune, because there was, of course, the fight against inflation, which, by the way, if I may, has been done very well by the Fed and by the ECB and by other central banks. All central banks have been very responsible in a period where inflation was picking up at 10% or even more than 10, and they could regain control largely. Of course, in the United States, it's particularly complicated because of the tariffs, because also of other elements that have an impact, inflationary impact, the immigration policy and so forth. And we will see what happens, but I have to say that the task of the Federal Reserve is very difficult. And I pay homage to Jay Powell for all what he has been doing since, I would say, the surge of inflation, all taken into account. It was highly responsible.
Jean-Claude Trichet, former European Central Bank President and our Chief North Asia Correspondent, Stephen Angle, thank you so much for your time today. Now let's do a check on Indian markets as they kick off. The rupee in focus as traders get back to work after the Diwali holiday. Prime Minister Narendra Modi has told Malaysia's leader he will skip the upcoming ASEAN summit in KL, missing a chance for a possible meeting with President Trump. The Mint reported yesterday that India and the U.S. are close to a trade deal that could lower tariffs from 50% to around 15%. Taking a look where we are in terms of the benchmarks in India, the Sensex up by 0.6%, inching ever so slightly. We also have the Nifty Bank Index in positive territory. Again, Prime Minister Modi talked about skipping that ASEAN summit in Malaysia. Now, the impact of U.S. tariffs on India's steel industry may be minimal in terms of direct exports, but they may lead to an increase in low-cost steel imports that could pressure domestic prices and hurt local producers. Let's get perspective from Jayant Acharya, Joint MD and CEO of JSW Steel, India's largest steelmaker. Jayant, good to have you with us. First off, could we get your reaction on, the optimism that the U.S. and India are close to a trade deal that tariffs could drop to 15%?
Yeah, thank you. Pleasure to be here with you. So I think the tariff negotiations are underway for India on an overall basis and for the steel tariffs as well. As you rightly said, the impact on India on a direct basis is very limited, but indirectly, surplus steel can find its way into India, and that's something which is a risk for us. Indian government is conscious and the industry is conscious about that, and we are taking measures to see that dumping does not take place.
And in relation to that, it is not just about the U.S., it's also about the EU proposing 50% tariffs on steel. You talked about dumping. Could that be an even bigger problem?
Yes, the European Union proposal, which has now gone to the European Council and the European Parliament, gives an indication that they are also concerned about the tariff impact which it may have on on Europe. And therefore, they're proposing to reduce the quota quantity and double their duty. I think we'll have to watch how it unfolds. However, I think the positive tailwind could be the reconstruction demand, which may come up in the Middle East and Ukraine post the cessation of the war. India remains a very positive growing market. We have been growing in double digits for the past 4 years. We see a strong growth for the next decade or two. And I think from an India domestic market perspective, we remain very optimistic and constructive.
The thing is, safeguards have been put in place, but despite those safeguards, we know that import volumes have been rising. How are you navigating all of that, and are those safeguards enough?
So the safeguards, when they were announced in the month of March, have been positive. The imports have gone down, but you're right. Over the last 2 months, import has inched up again. That's something which we need to watch. The uncertainty in the world is causing that move. From a safeguard and anti-dumping, we are looking at various anti-dumping measures as well on countries and products where we see an injury. Those are also being attended to by the Director General of Trade, and we hope to see some action on that soon. So we will have to keep and watch on the inflow of trade into the country. The domestic demand is one of the fastest growing in the world, and therefore we remain vulnerable to external challenges which may come in.
Right. So we know that those safeguard duties are due for renewal. It does make sense then for them to be extended by the government. Would you agree?
Absolutely. And the government has already proposed that the safeguard duties should be extended for 3 years. I think we should see that getting finalized by November or so, when it is up for renewal.
When it comes to raising steel prices, we know there have been headwinds. What need to happen? What factors need to align for you to be able to do that?
So on the positive side, let me say that July-September quarter, if you've seen our performance as well, we had a very strong operational performance in spite of a seasonally weak quarter in India because of monsoons and prolonged monsoons this time. The demand post-monsoons is picking up because, in Diwali, we have seen a very strong consumption sale on the back of GST reduction and interest rate reduction in India. And we are hopeful that the consumption story in India will actually now unfold at a faster pace. The capex by the central government and the state government, we will see that also going up in the second half of this financial year. And that also should aid steel demand. So from a demand perspective, India, we remain very optimistic as we go into the next half. The only thing which we need to be wary of is any kind of imports which comes into the country at low prices and impacts us. That's something which we will be working along with the government to see that at least dumping doesn't happen into the country.
How about in terms of iron ore supply? We know that there have been constraints. Constraints have been tightened. How are you looking at it?
Iron ore supplies in the country have to really move up in line with the steel production, which is going up. If you really look at the last year's production, we had a production of 152 million tons. We are expecting that this will move up by another 100 million tons over the next 5 to 6 years. So therefore, you will require a substantial amount of iron ore to be locally produced. The companies and the mines are being pushed to gear up for that. And the government is taking necessary measures to see that all the mines which have been taken up actually start producing wherever there are any constraints. So there is a government push to see that iron ore production in the country increases. We are hopeful that in the next 1 year, there are policies which are coming in for auction, which will make auction easier, will also make sure that people do not squat on resources. That means they get a mine on an auction, but don't sit on it. They should produce and see that the material reaches a market. Government is taking steps to ensure that, and I think that's very positive, and we look forward to a very constructive engagement of that.
Right. If you take a look at the next 12 to 24 months, do you see iron ore perhaps becoming, a bigger share of your raw materials sourcing strategy?
Yes. So, iron ore is the key ingredient for steel. As far as JSW Steel is concerned, we have about 23 mines, which we had won through an auction process. We have about 1.6 billion tons of resources. Out of that, we have certain mines are under operation. Some more mines are yet to come into operation as the approvals and clearances set in. In addition to that, as we ramp up our capacity from 34.2 million in India today to 50 million tons by the end of this decade, we continue to look for new assets which make strategic and economic sense for us as they come up for auction. So we are keenly watching the iron ore space. Our idea is to see that we at least have a 50% raw material security in terms of iron ore and coking coal both. And we continue to pursue that goal.
Jayant, I want to take a look at your joint venture with POSCO. What's the status of that? What's the timeline for this collaboration?
We are progressing on the documentation. I think both the parties are actively engaged to see that the documentation around the joint venture is closed soon. We have identified some land in Orissa for the putting up the works for the plant. We would be finalizing that in the next few months, and then we should be ready to go into the approval process for taking the requisite approvals for starting the operations. I think by the end of this financial year, we should be able to close everything and start getting the approvals, and maybe within a year start work on ground.
And what's the goal? What's the target for this joint venture?
Initially, we would be looking at a capacity of about 6 million tons in the east of India. And it can be scaled up over time to 10 million to 12 million tons.
Jayant, thank you so much for joining us. Jayant Acharya of JSW Steel. Now, before we go, here's a look at tomorrow's show. We'll get market insights from Monitor Senior Advisor Ifin Devitt, as traders brace for Friday's all-important U.S. CPI data. Plus, Lenovo APAC President Amar Babu will be joining us to discuss their regional growth strategy. Well, that is it for Insight. Horizons Middle East and Africa is next. Keep it here with us. This is Bloomberg.